What about something else that maybe we can use in conjunction? And that is called insurance. Now, many of you will have insurance in the room. You may have even had life insurance in the past. If you own your property, you probably had a life insurance policy whilst you were doing the mortgage. And of course, you will all, I imagine, insure your house, your car, because it's a legal right for it. Well, we have to insure our car, and the contents within our houses. Everything that we spend our money on, we want to make sure that if the house burnt down, we'd at least be able to replace it. So why don't we just insure the tax bill? Well, we have a saying, which is, would you rather pay tax on the seed or the harvest? So what does that mean? Well, to use a farming terminology here, the harvest for Mr. and Mrs. Jones is when they both passed away, their total estate is worth 1.5 million and is being taxed on the total estate. Now, when we're talking about the seed, that's whilst they're still accumulating, the estate is still there and they're still using it. So we're going to pay them a small monthly amount instead on the seed, so that at the end we don't have to pay anything on the harvest. And which is better to do? Well, I'm going to explain how the life assurance sort of works. Now, Mr. and Mrs. Jones buy a life policy for £260,000. It's £260,000 because that's the amount that they have to pay in inheritance tax. So we purchase that, and then vitally, it has to be wrapped in a trust. If it's not wrapped in a trust, all we're actually doing is, when they pass away, we're going to add £260,000 to their £1.5 million estate, and all that's going to do is increase their current problem. And we don't want to do that. So we need to make sure we wrap a trust around it. And when the second person passes away, what then happens is the children instruct the trust, which the life assurance policy is paid into the trust, they instruct the trust to pay HMRC the £260,000, and then in return the beneficiaries get to keep the full £1.5 million estate. So what that's done is it's helped to keep the money in the family, and it's also pleased HMRC because they've received the money that they are due. Now, this is how much it costs. So £260,000 for a couple aged 70 in good health, non-smokers, whole of life second death, because we don't want to pay it at the first death. And in trust, there's two options. One is called reviewable, which means in a few years' time they're going to be reviewed again, and because of course they're older, it's going to increase dramatically in price. It's £249.17 per month. Or you have guaranteed cover. Now, guaranteed cover means that it will remain that price for the rest of their lives, no matter how long they live, and it's £580.45 per month. Now, that may sound quite expensive, but there are ways of funding it. So what we could do is we could set up a discounted gift trust, use the income from it for the first 7 years to pay for the insurance, therefore covering off that side, and then we may not need the life assurance after the 7-year period. And the same goes for the wealth preservation account. We can use some of the capital out of that to help to pay for it. Now, for the guaranteed cover, for Mr. and Mrs. Jones, they need to live 38 years for them to have paid more in premiums than they will in tax. So they'll be 108 by the time they've actually paid more out to the insurance company than they would have received back. So when it comes to life insurance, it's a very easy way of solving it. And really, we generally like to combine the two types of products. So maybe we do a discounted gift trust, that pays for the life assurance, so it's not physically costing you anything, and at the same time is helping to protect your estate so that you don't have to worry about it, and that we ensure that your family don't end up picking up a rather large tax bill.